So the tenant was paying for 1 year rent. Now what happened? We have July passed, July, August, September, October, November, and December. 6 months passed and you are now standing on 31st of December. So how much from this rent has been consumed? So this is prepaid rent, rent in advance. So we have consumed rent. How much? 50%, like 6 months. But remember, the business here is rental company, right? So the question belongs to that their sales are renting services, right? So now let's do that. So it means this is they receive their sales in advance. So does they perform the services? No. How much services they perform? 50%. Because at the end of the 2014, 50% of the unearned rent revenue has been utilized. So what is the entry? Unearned revenue to revenue, which means unearned rent revenue to rent revenue worth 7,500. So many students, they are confused, sir. We are talking about the rent. So that is not the revenue, right? It should be the, the rent expense to prepaid rent. But remember, the company, their sales are renting services. So that's why the word here is revenue here, right? Similarly, if you go to the salon, the hair cutting, their sales are like they perform hair cutting services. So that is the service industry. In service industry, you need to pay close attention that what are their core products that they are selling. So they are selling renting spaces. So they receive rent in advance. So that would be their advance sales. Entry would be cash collected in advance to liability unearned rent revenue. They just made that one. And then after 6 months, now the liability has converted. Now they have a right to record it as a revenue. Recall your matching principle that you need to record the revenue when it actually earned, when ownership is officially transferred. So now you can just have a right to record it as a sales. So you make the entry, decrease the liability. Decrease in liability means debit. Sale increase, credit. Entry would be unearned revenue to revenue. Right, guys? Harry?
Yep.
Good. Now answer this question. Interest revenue of 900 has been earned but not yet received. Now you need to pay very close attention to the words. So they said interest revenue. Interest revenue. These are not the expenses. It means they are receiving interest. These are their revenues. So they have earned the revenue, yes, but did they receive the cash? Can they record it as a cash increase? No. Then what they recorded as? Interest receivable to interest revenue. They create customer, like in sales we create customer account receivable, but here we are receiving interest, so that would be interest receivable. Or if you can just write it down, receivables to interest revenue, that's okay. Understood. So you need to pay very close attention where you are standing right now. You are standing on 31st of December. And what this account basically belongs. It is expense account, revenue account. Then you need to realize that, plus you need to pay very close attention that what are the core services of the company, right? Then the whole situation gonna be very clear and it is easy for you to make the entries. Because some students, they are confused, sir, this is interest and interest is our expense. Now interest can be revenue. If you are in that business in which you are receiving interest, that would be your revenue, right? Okay, now let's go to record the depreciation. So equipment was purchased at the beginning of this year at cost of 50,000. The equipment useful life is 5 years. So you can divide 50,000 divided by 5, answer would be 10,000. So the useful life must be that you use this equipment in 5 years. So this year you have used 10,000 worth of equipment, right? Yeah. Now you need to record the depreciation. What is the entry for depreciation? Depreciation to accumulated depreciation, right? This will go to balance sheet, and this will go to income statement, right? Look at our expense and revenue recognition. Expense belong to income statement, revenue belong to income statement. So these expense and revenue belongs to income statement of that year, so that go to income statement, right? So pay very close attention to the words, to the dates, to the business operations. So what happened to the left value of the asset? So accumulated depreciation will go to balance sheet. How we are going to write down, how we adjust in balance sheet? Equipment worth of 50,000, right? So you write down less accumulated depreciation 10,000. So that is the book value of equipment, right? Everybody understand that? So this is how we write it down, equipment and accumulated depreciation on balance sheet. Any question yet?
No questions.
Good. Hyunjin Kim, Pinyu, Marilyn.
No questions, sir.
No question.
Good.
No.
Okay. Now let's move to our next learning objective, which is construct the financial statements. So we already know the format of the financial statement. Let's just see that. We already know the link as well. First, we will make income statement, right? So all these transactions that we have converted into journal entries will go to the ledger, T accounts, from where we find out the balance. We write it down balance in trial balance, and then we make income statement. Income statement, what is the formula for income statement? First we write down the revenue and then less all the expenses. So you see revenue and then all the expenses, right? We have found net income 2,900. And then the logical next financial statement would be retained earning. So we have beginning retained earning plus the income minus any dividend that we paid. We paid dividend of 3,200, so that would be the retained earning 18,500, and that will go to our here. That will go to our balance sheet here. So all the accounts are, we write it down here, everything, and that would be the linking of the statements, that the hierarchy of the basically financial statements, which statements we make first. First we make income statement, then we make retained earnings statement, and then we make balance sheet, right? Now close the books. Okay. Close the books means all those accounts that belongs to income statement must be closed, right? So for example, sales for the year 2014, we close that registered, place it into our history cabinets or cupboards, or we save the file for our record. Okay, in 2014 we have this much sales. So only those accounts we are going to close it which belongs to income statement, right? Like sales, like expenses, right? So can we close asset? No, because assets move on, which shows the worth of the business. So assets account, they are not closed. They carry forward. Their balance carry forward. Cash account, they carry forward. But expense and the income